Hey, it's Jonathan. Thanks for joining me today. I want to continue our series discussing the fundamentals of the market. And today we're going to talk about interest rates. We're also going to touch on some other essential aspects of the economy that correspond, that go right along with the interest rates, which is quantitative easing and quantitative tightening, and the repo market, the reverse repo market as well. So we're going to look at how this correlates with our market cycles. So I'm on my website. We're going to go down to the learning section on the website, look at the market cycles here. We're also using the Forex factory calendar. And we see that the federal fund rate is 4%. This came out as expected. And the interest rate is the rate at which depository institutions lend balances held at the Federal Reserve to other depository institutions. So this is the lend. Basically, just to make it simple, this is the lending rate between banks. It says the actual higher than forecast is good for the currency, and essentially it is good for the currency. It might not be good for the market. It just depends on where we're at, but in the cycle. But it is good for the currency. There's lots of good information here. I encourage you to hop on and sift through this information yourself. The rate discussion is usually priced in to the market, so it tends to be overshadowed by the FOMAC statements. So the FOMAC statements are they are important. This determines where the market's going. This is where they let you know where the market's going, which is focused on the future. So the FOMAC statements are very important, and you see the FOMAC statements right here, which came out the same day. So this is very important that you hear what right now Chair Powell has to say about where the interest rates may go in the future and what their thoughts are behind their decision on the interest rates this time. So these statements are a forward-leading indicator of where the market may go. So that is very important. What I'm going to talk about today, really, we may go over some of the FOMAC statements and all that stuff. Really, you just listen to them is what you're going to do. But I want to talk about exactly how the interest rate works. So let's see, I've written up some notes here. And so what is the federal fund rate? The federal fund rate is the rate at which banks lend to each other. This rate affects the rate at which banks lend to their consumers, right? To the consumer. Money is created when someone borrows money or receives a loan. So let's say this. Let's say you have a credit card. We'll do this on the consumer level, but this is how the banks work as well. If you have a credit card and you're going to you go to purchase something, that money's not there yet, right? It's not in a bank waiting. It's credit. It's a debt note, right? So when you swipe that card, you're creating debt, and you're promising to pay that debt note back, right? This is essentially when money is created, is when that debt note is created. Now, as you pay that money back, the money is in the system, right? When you swipe that card, that money is created and brought into the market, right? Into the system, and then when you pay that money back, that money disappears. It goes out of the system, right? It's not in the market anymore. It goes back and it pays off that debt and it's gone, right? So it becomes dead money. So money is created when someone borrows money or receives a loan, okay? And this happens when the bank or anybody borrows money or receives a loan. This is when money is created, essentially. This is real high level view of it, but before quantitative easing, money was created by the Federal Reserve buying short-term Treasury bills under 1-year duration, which would in turn inject money into the system. Okay, so what a Treasury bill is, just a quick note here. What a Treasury bill is it's basically more than likely it's government debt. So what it is you're buying government debt, and the government is promising to pay that debt back to you. Okay. So that's what a treasury bill is. It can be other things as well, but it's normally what it is. With quantitative easing, money is created by the Federal Reserve purchasing long-term treasuries. Okay, so we switch from short-term treasuries to long-term treasuries. Quantitative tightening is when the Federal Reserve stops purchasing treasuries. When the treasury they've already purchased are paid back to them, the money becomes dead money and removed from circulation, restricting the money supply. Okay, so when you want to quantitatively ease, right? What happens is the Federal Reserve will pin up some money and then they will buy some government debt. In turn, they're holding that treasury on their balance sheet, and they're being paid back, right? Because that's government debt. They've loaned out some money. They've printed up money that didn't exist, okay? And they've bought this debt note, and then that money is being paid back to them, right? Um, and that's how they would inject money into the system, by printing money and buying government debt with it, right? Or other debt, but mainly government debt. Well, then when you want to tighten, what happens is they stop buying these treasury bills. Okay, so they're just going to say, look, we're going to, we're don't want to inject any money into the system, because the more money injected into the system creates inflation, right? Um, so what they want to do is they start QT, quantitative tightening, and as those treasury bills that they've bought are paid back to them, that money they just take and they destroy it. It becomes dead money. Okay, so this is how they pull money out of the system. Okay, so when they want to put money in the system, they print it up and buy treasuries. When they want to pull it out, they just wait for those treasuries to be paid back, and they take the money and destroy it, and that becomes that money goes out of circulation. Okay, same thing with a credit card, right? Like I for the first example. Let's see here. Okay, so that's quantitative easing and quantitative tightening. Okay, that's how money is printed, and that's how money is taken out of the system. As money is destroyed, which removes it from the system. Okay, so it's all about the supply and demand, right? It's all about supply and demand. Um, so the more money in the system, the cheaper money becomes, essentially lowering interest rates. So when you have a whole lot of stuff, then people are willing to loan out money. If there's a whole lot of money, then people are willing to loan it out at a cheaper and cheaper rate, because everybody's trying to loan money out, right? So when money becomes scarce, interest rates rise. So when there's not a whole lot of money to loan out, then the interest rates will rise. Okay, and this is how the Federal Reserve controls the interest rates. To ensure that money is not loaned below the Federal Reserve target rate, they have created the reverse repo. Okay, so the Federal Reserve will create target rates, and you see here, you see source set the target rate range from 375 to 4. Okay, so that's their target rate, is 375 to 4%. And so what happens is, to ensure that money is not loaned below the Federal Reserve target rate, they have created the reverse repo. So what happens is there's some money floating around out here, but people want to get a return on it, and they're like, okay, well, I'll loan it out to you for 2%. Well, what happens is the Federal Reserve created the reverse repo. It's like an overnight account that they can put their money in, and they'll receive interest on it. Okay. Um, and what happens is that, why would you go loan money to somebody that was, you were they may not pay you back, or they may pay you back, if you can just loan it to the Federal Reserve, and they'll pay you interest on it for a certain percent of interest. You're not going to loan it to somebody else for a lower percent interest than that. Okay, the Federal Reserve offers overnight interest to those who will park their money in the reverse repo market, essentially creating a floor interest rate. Okay. It would not make sense to loan money out below the interest rate that the Federal Reserve will pay you for it, right? Essentially, the Federal Reserve controls the interest rate by controlling the amount of money that's in the market. So this is the way the Federal Reserve controls the interest rate. When the Federal Reserve prints money, the price of assets, stocks, real estate will immediately go up. So when the Federal Reserve starts printing money, then money's more available. People are going to start investing. That's when you see the price of assets, stocks, and real estate, things like that. It will immediately go up. You see that we're in our cycle here. This is the part of the cycle when they start quantitative easing and printing money. Then the market's going to start moving up. Okay. Let's see where my notes are. So the market will start moving up. Inflation will kick in and the price of goods and services will go up. Okay, so you got the market moving up, and real estate and all this stuff. Well, then the price of goods and services start going up. So, the price of commodities and things that you need to build stuff. Goods and services, right? The price of services will go up, right? When price and services go up, when goods and services go up, then the price of wages must go up to meet inflation. So that's where we're at right now. The price of goods and services have gone up. The price of assets have gone up. Real estate, stocks, all that stuff. Well, now the price of wages must go up to meet that. So then the price of wages must go up to meet inflation. This is usually the point at which the Federal Reserve will withdraw money from the system. This kind of screws the small guy, because what happens is if you don't have the money to invest, or were not knowledgeable enough to invest, then what happens is you miss this increase in assets, right, in your stocks and real estates and things like that. So then, inflation starts kicking in, and goods and services start becoming more and more expensive. The price of everything starts going up. Food and all this kind of stuff starts going up. So now you're paying inflation. And this is the point that when we get to the point where wages must go up to meet that inflation, this is the point that the Federal Reserve says, "Oh no, we can't have this cycle, where we have inflation, then wages go up, which produce more money, put it back into the system, and then create more inflation." This is the wage inflation spiral that they're talking about, right? So we can't have wages go up any higher. So what we're going to do is we're going to cause a mini depression or a mini recession, and to lower inflation so that wages will not rise. And this is the point. This is why Fed Chair Powell is saying that he's looking at the unemployment, because that will restrict money from the system. That will pull money back from the system. So there's a couple more things that I want to look at. This is essentially how the interest rates work. I want to look at this. This I found interesting. What we have is we have the 30-year Treasury in blue, the 2-year Treasury in black, and then we have the effective the federal the interest rate in yellow. Then we have the upper limit in green and the lower limit in red. If you look back, then what you see that the interest rate follows the 2-year Treasury. The 30-year Treasury acts as kind of a resistance to this. It has over a number of years. It's kind of a resistance to the 2-year. The 10-year kind of acts as a resistance to the 2-year, right? 30-year acts as a resistance to the 2-year. But usually when we see a reversal, so you may be asking yourself, when are we going to see interest rates come back down? Usually when you see a reversal on this is when the 2-year Treasury crosses the effective rate and stays within its bounds for a period of time, and then we'll see it drop through, right? For instance, let's see if I can blow this up. So we see here that the 2-year in black came down to meet the effective rate, and it was unable to break out. It kind of bounced in between the upper limit and the effective rate, then it went to the lower limit and the effective rate, and then it broke through, and then we start seeing that downturn in the effective rates. If we slide this over to today, we see all of them increasing. The 2-year has just crossed the 10-year, and the effective interest rate is moving up towards that window of the 2-year. You can look back through the past. Well, they haven't been doing the upper and lower limits for that long, but you see how the interest rates usually follow is a very good indicator. The 2-year and the interest rates are a very good indicator as to where that interest rate is going. For instance, right here, you see that they crossed the effective rate and the 2-year crossed. They ran parallel for a little while, and then we started seeing a decrease in interest rates. I'll let you look at that. That's on the Fed website. It's just kind of interesting how the 2-year and the effective interest rates run side by side. So you might want to take a look at that. And so when will the interest rate, if things stay the same, when will the interest rate start coming down? Is when the 2-year Treasury and the effective rate run parallel for a little while. Then we'll see the decrease in the interest rates. Also, the reverse repo market. We talked about the reverse repo market. The reverse repo market is again where the people store their money, and this is how the Fed creates a floor to the market. The Federal Reserve offers overnight interest to those who will park their money in the reverse repo market, essentially creating a floor interest rate. And just to show you, this is something that I look at. Look at all the money that's parked with the Fed. Let's go back and let's actually look at more history than we have. If it will load, you see, I mean, all the way back here, 2016. Look at the spike in the money that is parked with the Fed. So this is one thing that I'm looking at fairly closely to see when this starts coming down. When this comes down, then that means that the money has found a more desirable place to receive a return than just parking it with the Fed. And again, this is how the Fed creates the floor to that interest rate. So, okay, I hope you found this useful. Information, and like and comment, share. I really appreciate it. It helps the video get out. Make sure you check out our blockchain friends, Magic Square NFT and Art by Annora, all that stuff. Y'all are beautiful, and I will see you next time.